All right. Well, I think we're all set and ready to go here this evening. Thank you, everyone, for your patience. Appreciate seeing everyone back here again. A little bit different last week with our recording. We actually had to do the phone-in type of training, so hopefully it worked out all right for everyone just to basically get to watch slides and hear my voice. I haven't done books on tape yet, but if you enjoy it, please let me know and I'll see if there's another opportunity here for me. But what we want to talk about tonight is really kind of the fun part about VITA. The first couple trainings we had, first session was talking about things like filing status and dependency, really the areas that we have to make some determination on using our 4012 other resource material to figure out how we're going to file a return. Last session we had talked about income. That's putting down on the 1040 itself all the items of income, the things that are going to be taxable, taking a look at the government forms and making sure that we have those basically accounted for correctly. Today's the fun night. Now we get to talk about how we remove items of income. We're going to talk about how we actually deduct items from taxes. We're going to talk about tax credits. So we're really going to show about how our VITA clients will be getting money back from the government, either money that they paid in, or we'll talk about some very amazing tax credits later on in the evening. So one of the first things we want to talk about is some items of adjustment to income. And this is actually going to be an opportunity for individuals to start reducing some of their income that's subject to tax. And there are going to be a couple key areas that we want to talk about. They're going to include things like the qualified educator expenses. One thing we did take a look at last time when we looked at interest was an item called early withdrawal from savings accounts, an early penalty if you're taking money out of a CD or a savings account before the appropriate time. If you enter that amount in the form 1099 INT, it's actually going to carry directly over to the 1040. It's going to be an adjustment to income showing up on Schedule 1. A couple other things we're going to take a look at will be some alimony deductions. We'll go into a little bit more detail. We'll also talk a little bit more about some things of IRA contributions. Typically, we don't see these very often within VITA, but if you do have a client who either is interested or tells you that they've made a regular IRA contribution, not a Roth contribution, that regular IRA contribution may be deductible and be an adjustment to income. We'll talk about a couple other things, some very popular ones, our student loan interest, and then also talking about some changes in tuition and fees. In the past, tuition and fee deduction has been included. This is an item that is currently not extended for the 2018 tax year. We're still waiting on year-end extension legislation. So at the current time, the tuition fee deduction is not available. Congress has been slightly busy over the past couple weeks campaigning. They'll eventually get back into Washington, and hopefully we'll start a bill on extending these lapse provisions. We will keep you updated if anything happens before the end of the year. If not, we may see some legislation happen in the beginning of January. With the tuition and fee deduction, however, typically most clients will get a higher tax benefit by taking one of the education credits that we'll be talking about a little bit later on this evening. A couple things that we did want to spend a little bit more time on. The educator expenses, you'll find this on the E3 of your 4012, which is one of your first handouts in your packet. One of the nice benefits that we have here is an educator is able to take deductions on items that they're paying for school purposes. They don't need to itemize deductions. In fact, we're going to see very few clients itemize deductions anymore, which is one of the reasons we moved that to an advanced topic. So most clients we're going to see within VITA will now be a standard deduction taxpayer. But we do have an opportunity for qualified educators to take a deduction up to $250 per individual on the return. So if you're a married filing joint return, you can take up to $500. The issue is each taxpayer must have $250 of expenses to get the maximum. So it's going to be the lesser of your actual expenses or $250. Now, when we take a look at who a qualified educator would be, the definition is fairly broad. It's actually going to be a teacher, an aide, a counselor, a principal, someone who's termed an instructor in a school setting. It's going to be through K through 12. So if you're teaching anywhere from kindergarten through 12th grade, you work at least 900 hours a year, you're a qualified educator. Now, most of the things that we're going to take a look at are going to be qualifying. Unfortunately, if you are a homeschool instructor, that does not count for the educator deduction. So homeschool educators are not part of the process. Most items that you are going to spend for the classroom setting would be includable in these amounts. So books, supplies, materials, that includes things like computer software, or computer applications, or any other type of computer hardware or software. any other type of materials that you might be using, supplies. If you're going ahead and doing even continuing education that's not reimbursed, those would be qualifying expenditures for purposes of this deduction. So one thing we do want to take a look at, we'll talk about a couple unique things in the tax code this evening, and we'll talk about how some of these deductions, some of these credits only apply to specific individuals. One of the things we're going to take notice of is, for some reason, healthcare teachers and physical education teachers must have upset a congressman or senator, because healthcare instructors or physical education instructors are not allowed to take the educator expense deduction if they're buying materials that are not related to athletic supplies. So they're not allowed to take the deduction. So one of the things we may want to take a look at, quite often we get a lot of individuals coming into VITA. You may see a W-2 coming from a school district or an IU who could be qualifying under the educator deduction. You can simply ask, do you have any educator expenses that you would like to claim this year? Generally, we'd like to frame the question that way rather than, how would you like a $250 deduction off your return this year? All you have to do is nod your head yes if I ask if you have more than $250 of qualifying expenses. Again, what we're going to do is provide information for the taxpayers. They're going to be the ones that have to be supporting this information with documentation in case the IRS would ask. But it is an opportunity for individuals to take a nice reduction off their income. Again, we do want to ask if they do have any expenses. For federal purposes, we're going to be limited at $250. For Pennsylvania purposes, we can still take unreimbursed employee expenses, which we'll talk about next week. There is no cap for educators. So the $250 is only a federal cap. For state purposes, we can actually take their actual amount of expenses. We do want to ask if there's any reimbursement, if they're getting any type of reimbursement from the school, if they're getting reimbursed through a grant program, anything that would be considered a non-taxable reimbursement, we do have to reduce those qualifying expenses. But a fairly nice deduction that's available for educators. One of the other things that we may take a look at in situations of divorce is alimony paid. This information is found on E8 of your 4012. One of the corollaries that we have is that for the income section, we had mentioned that alimony income is subject to taxation. And what we're going to see is we have a kind of corollary effect that if you pay alimony, that will be a deduction from income for you. And a lot of people may come into VITA and say, hey, this is great. After the current year, I don't have to worry about alimony anymore because it's not taxable. Well, that's partly true. The alimony rules have changed for any divorces after December 31st, 2018. So by the time you're seeing someone in VITA, if they had any alimony paid or alimony received in 2018, we still have to abide by the rules. In fact, their payments are still going to be handled the same way going forward unless they substantially modify their divorce agreement. The new rules only apply for divorces that have been finalized after the first of the year. So when we take a look at alimony income, if you receive alimony income, that will be taxable income to the recipient. The payor actually gets an opportunity to deduct that from income. And there are a couple situations we have to go through. Basically, alimony is going to be treated as alimony under a couple very specific conditions. And we're going to go through some very unique definitions of how these work. But traditionally, what we're going to see is alimony has to be paid with either in cash or some sort of cash equivalent. It has to be required by a divorce agreement or separation agreement. It can't just be out of the kindness of an ex-spouse's heart that they pay more than what they're supposed to. We don't often see that situation, but they can only deduct what they're required to pay. So it can't happen on anything higher than that. Couple kind of unique rules. The IRS does specify that the payor and recipient are not allowed to file a married filing joint return, which would be odd why you would pay alimony to an ex-spouse you happen to be married to. It just logically doesn't make sense. However, the definition's there. So the IRS wants to reiterate that you cannot file a married filing joint return with the person you're paying alimony to. Those of you good at math, you'd have income coming in and deduction coming right out, so it really wouldn't matter anyway. But if someone's married and they say, I pay alimony to my ex-spouse and I want to file a joint return with them, we may want to have a conversation about how they're actually filing. There is no alimony in that situation. One of the other kind of fun definitions, for those of you who are fans of the English language, we do have a definition to say alimony cannot be considered alimony if the agreement says it's not alimony. So if we read the short definition, basically the payment's not alimony if it says it's not alimony. we have two negatives in the same sentence. So as long as the agreement says it's not alimony, it's not going to be considered alimony for purposes of deduction. So the agreement can't say it's not alimony. It's effectively how the wording looks. So we just cross out the double negatives, and the agreement basically has to say these payments are alimony. So if the agreement somehow says that they're going to make certain additional cash payments, the agreement says that they're not going to be treated as alimony, we're going to follow that same rule. They're not going to be alimony. One of the other things we take a look at as well is that if the spouses are legally separated or divorced, they cannot be still living in the same household. So they cannot go ahead and take an alimony deduction if they're sharing the same household with a spouse or former spouse that they're legally separated or divorced from. One of the other things we take a look at, typically alimony will be terminating upon the death of the recipient spouse, and also be sure that child support payments aren't trying to be included in there as well. So child support is not deductible, only the alimony portion is. The one thing we're going to see here is that the IRS is very good at matching these amounts up, because as we kind of looked at in the income section, alimony is a reportable item of income. In order to deduct alimony, you need to know the Social Security number of the person you paid alimony to. It's one of the requirements of deducting alimony. So in order to do that, the IRS is going to match up the deduction with the recipient spouse's Social Security number. Then they're going to go to the recipient spouse's tax return and make sure that they're reporting the exact amount of alimony income. So there is a matching program from the IRS. So we do want to make sure that we are ensuring that we not only have the Social Security number of the recipient, but also understanding what the agreement says. Hopefully people understand if they're paying alimony and how much it should be. One deduction that's probably a little bit more popular that we'll see is actually the student loan interest deduction. That's typically going to be found on a Form 1098E. So if a taxpayer comes in with the Form 1098E, that's generally going to show how much interest they have for student loans. A little bit more information will be found on the E10 of your 4012. Couple of things we take a look at for a qualifying student loan. It has to be a loan taken out for educational purposes, has to be taken out either for the taxpayer, their spouse, or dependent, or someone who was a dependent at the time the loan was taken out. So if the loan was taken out and it was for a child who was a dependent at the time, and now the loan's being repaid later, as long as the parent is required or responsible for loan payment, they're eligible for the deduction. A couple other things that we have to take a look at. The loan has to be paid within a reasonable amount of time after receiving the loan, and the loan has to be taken out for an eligible student, meaning that they have to at least half time at an eligible institution. And an eligible institution would be, if you have a question about it, most things that say college or university are typically going to be an eligible institution. There is a Department of Education website that we can go to verify whether or not they're registered with the Department of Education as a qualified institution. But if you have a person who says, I went to Hang Loose Bob's School of Surfing in Hawaii, and I was on the 8-year plan and got a associate's in surfing, that may not be a qualified institution and probably shouldn't take you 8 years to get an associate's degree on at least half-time basis. So if they're coming up with something and saying we use the proceeds and it doesn't sound right, certainly double check. Most people who have a 1098E are going to be attending an eligible institution. One of the other requirements that has to be paid back within a reasonable amount of time after the education has ceased. Generally not a problem with student loans. If anyone has seen student loans, they're very good about asking for payment either shortly after or even before graduation. They want the payments to start. So typically these requirements are going to be met. What we're going to see is that we have a deduction threshold here. We also have an AGI limitation. Most cases in VITA, we probably won't be bumping into the AGI limitation too much unless they're at the upper end range being VITA eligible. But if there is some limitation, TaxSlayer is probably doing the calculation correctly. There is limitations, particularly on single individuals, that they may not get the full deduction based on their AGI. But the amount that they can actually deduct is either going to be the lower of the amount they actually paid or $2,500. Now, in most cases, we'll probably see the 1098E. You may have a couple 1098Es coming in, depending if they've taken a variety of loans out. We can just simply add all those amounts together and enter it on the return. Most cases in VITA, I think, will be fairly close, or maybe some phase outs. People may not be able to take advantage of all the student loan interest they pay. Again, it's only a $2,500 deduction. I have seen some positions where their student loan interest is in the 60,000 plus category a year for the interest. Now, they're also phased out for AGI, so it really doesn't matter anyway. But a couple things we take a look at. You'll find a couple of common themes tonight, with a few exceptions. In order to take student loan interest deduction, you may not file married filing separately. Kind of going all the way back to session number 1, talking about filing status, married filing separately is going to be a problem for a lot of the things we'll be talking about tonight. So you can't be filing separately and still take the student loan interest deduction. You may also not be claimed as a dependent on another's return. So if you're being claimed as a dependent, you may not take the student loan interest. You have to be legally obligated to repay the loan. So if you're not the borrower, the co-borrower, you're not eligible to take the deduction. What happens in this case, and we often get this question coming in, that someone says, well, I'm helping to pay a student loan for a nephew or a grandchild or my own child, but I'm not responsible for paying the loan. How does that work? Well, typically, what it's going to be treated as is a gift to that individual. And the individual who's legally responsible, you can still take the student loan interest deduction as long as you meet the other qualifications. We talk about when we get to our education credits. So for purposes of a qualified student loan, it can be tuition, it can be fees, it can be required materials, it can be even room and board. So oftentimes we'll see people who take student loans out. And they're going to use those for housing. All right, so those are kind of our common areas that we use are no longer eligible deduction. It's only eligible for military personnel. So moving expense is no longer an adjustment to income. And if you have questions about what would be in scope within VITA, that would be on our E1, which a little bit of foreshadowing, something for you to look forward to in the beginning of the new year. So a post-holiday Christmas or Hanukkah New Year's gift. The 4012s when they're fresh off the printer. All right. But we do want to talk about a couple common credits. We're going to take a look at a few non-refundable credits that are going to come in. These are very good opportunities for clients. And we're going to start off with the word good. We'll kind of work our way up to some better adjectives a little bit later. These are going to be found on on the Form 1040 Schedule 3. So not in your handout, but when you actually go ahead and take a look at these, if we do qualify for the taking these credits, it'll show up on the Schedule 3, which will then move its way over to page 2 of the 1040. One of the first ones we want to talk about is the foreign tax credit. Foreign tax credit is typically going to be within scope of VITA. What we're going to see in this instance is most times we'll see the foreign tax credit is generally coming off investment income. So taxpayers may have investments, they may have mutual funds, they may have a stock fund, they may have direct ownership in companies that pay foreign taxes. Generally, you're going to see this coming off a Form 1099 INT, more specifically probably a 1099 DIV. As long as the foreign tax is being reported on a government type form, 1099 INT, 1099 DIV, or a Schedule K1, and the amount is less than $600, we can actually make an election to not file the Form 1116, which is a relatively complex and longer form, and instead go ahead and just take that as a credit on the return. So whatever amount is shown there, we can go ahead and take that as a credit directly on Schedule 3. And that'll be on line 48 of the Schedule 3. We don't often see these, but sometimes if you take a look at a brokerage statement, you'll see that there is an amount for foreign taxes paid. If that's the case, just simply enter the information exactly as you see it on the 1099 DIV screen. And the system will ask if we'd like to make an election to not file the 1116 and take the credit, and that's the process we'll follow. A couple things we're going to take a little bit longer look at are going to be things like the child and dependent care credit. That's going to be coming off the Form 2441. We're also going to be taking a look at the education credits. These are, again, a fairly popular credit on the 8863. And we're also going to take a look at our retirement savers credit, which is the 8880. So we're going to spend a little bit of time right now going through a few more of those credits in a little bit more detail. First one we'd like to talk about is going to be our Child Independent Care Credit. This is off the G6 of your 4012, a little bit more information for you there. For the most part, these credits have not seen any changes in the past couple years. These are relatively unchanged from what you may have been acclimated to if you have done these in the past. The nice part about the Child and Dependent Care Credit is that every taxpayer who has these credits is eligible. While the amount may change based on their AGI, there is no maximum AGI phase out. So if Bill Gates would come in to your VITA site, and let's just assume for whatever reason he passed the test under the 211 to be able to come in, and you said normally we can't do your return because you have to be under 62,000, but we're going to make an exception, and if you make several $1 million a year, you're still eligible to take the credit as long as you meet the other qualifications. So all of our VITA clients will qualify if they meet the qualifications, and there are certain things we want to lay out here. So when we take a look at the credit, we can get up to $3,000 for one child. If you have more than one child, you can take up to $6,000 of a credit. Now, what we're going to take a look at is a couple different things. One thing I do want to point out, if you have a W-2, you do want to double check to make sure if there's any amount in box 10. Box 10 is specifically a dependent care credit amount. That would be an election a taxpayer has made to have pre-tax withholding of dependent care credit benefits. So that amount, if you see it in the W-2, again, you're just going to input that directly into the 1040 W-2 screen. Once you do that, the system's going to prompt you to fill out a 2441. It's going to be pretty important to do that because if we don't fill out a 2441, that amount now becomes taxable income. So we do want to just make sure that the taxpayer does qualify to take a dependent credit, because typically if they've had it withheld, it means that they probably have incurred some expenses, and we can actually file a 2441 to make sure none of that becomes taxable if they met all the other rules. So there are a couple eligibility rules that we're going to take a look at. The first one is kind of going under the credit's name. Basically the credit for child care. And a child in this case, and we'll probably see there are many different ways the IRS is going to define the term child. This is one of the other ones that we'll see, is a child is anyone who has not yet attained the age of 13. So once a child turns 13, we can no longer take a child care credit for them. So this is one area where we don't have to wait till the end of the year, like we have with dependent testing or anything else. This can be taken all the way up until the date the child turns 13. So if they have care costs incurred before they turn 13, we're more than welcome to take those. Apparently under the IRS rules, once a child becomes a teenager, they're more than capable of taking care of themselves. They need no one else to be able to watch them, give them a device, give them some money, and they're good to go. But basically the age of 13 is our cutoff there. Once they hit age 13, we can no longer take the credit. One of the things that we have to take a look at is it's typically going to be the custodial parent that's going to be taking the 2441 credit. So basically, we're going to take a look at the custodial parent in this case, even if they're not taking the dependency exemption. So just one thing to watch in cases where you may have a situation where someone's trying to take a child as a dependent, and we'll take a look at the child tax credit. A non-custodial parent can take those purposes for dependency and for the child tax credit. But usually the custodial parent is going to have all the other benefits associated with the child. So dependent care credit will follow with the custodial parent. Now, in addition to the child, there are also a couple dependents that can qualify as well. So if you are a dependent of a taxpayer, and that dependent has issues that they are not capable of caring for themselves, so whether a physical or mental incapacity issue, and they require care. And generally, we'll see some definition of care. G6 will go through a few of those items. Basically, it's going to be requiring help with eating, feeding, dressing, medications along those lines. Someone who really can't be on their own, someone who needs someone to watch out for them. They would be eligible for the dependent care credit. Again, we'd be looking at the same type of issues. They have to live in the residence of the taxpayer for at least half the year. So that's one of the other conditions we have. So they have to be with the taxpayer. We also have the opportunity for a taxpayer's spouse. to be treated as a dependent care credit. Again, they would have to meet the rules of being either physically or mentally incapable of caring for themselves, but they would also be treatable as a eligible individual for the dependent care credit. In general, if we have a married filing joint return, both spouses have to have earned income. So this isn't a situation where if you have after-school care that an individual says, I'm going to hire a babysitter, I'm going to go out. Both spouses have to have earned income. There are a couple exceptions to that. One, if the spouse, like we just talked about, is incapable of caring for themselves, then the earned income is waived. There's also a condition if the taxpayer spouse is a full-time student, that we can also waive the earned income limitation for them as well. A little bit more information in your 4012 if you do run into that situation. Most individuals will probably know if they're a full-time student or if they have a job. What is very unique about these costs, though, is a lot of things actually can qualify for child and dependent care credit. If it's a before school or after school program, whether it's run by a nonprofit organization or actually a babysitter or child caregiver, these would count. One unique aspect is some people say, well, we don't actually have any after school programs. You can ask, did the children attend a summer camp? As long as it's not an overnight camp, as long as it's a day camp, it doesn't matter whether it's for soccer, Harry Potter, Legos, whatever the case may be. If they're in a skilled care facility, if they're in a place that has someone watching the children, and both taxpayers have earned income, they may qualify. The one caveat, we need to have a taxpayer identification number for the person providing care. And this is sometimes going to be a stumbling block. You may talk to a taxpayer and ask, I see that you have some young children. I see that both you and your spouse are working. Do you have any care expenses that you incurred? And some people may say, yes, we do. We pay someone, a neighbor of ours, to watch our children when they come off the bus until we come home from work. We have to have a taxpayer identification number for the caregiver. If it's going to be an individual, we have to know their name, their social security number. It's going to be a requirement to fill out the form 2441. Again, the IRS is very good at matching numbers up. And what they do with that information is once we put a taxpayer identification number down, they will then go take a look at the return of the person we put down as a caregiver and make sure that they've reported that income from child care. So just to let you know, there may be some situations you may ask, can we get your neighbor's social security number, and we'll run into a problem that the individual may not want to give their social security number. Same thing can happen if you say that the client comes in and they have a relative that helps watch their child, and they pay the relative for things like snacks or other kind of recreational activities. You can use that as well, as long as that relative's willing to give their social security number and report that amount as income on their return. Most cases, if it's going to be a institution that's providing care, a YMCA, an after-school program, a recreational center, they will generally give a form that actually gives her employer identification number. If someone says, hey, I've taken them to the Lancaster YMCA, I don't know what the number is, you can either do a quick internet search, sometimes they have it right on there, sometimes a quick phone call right around tax time, and they generally answer the phone with their EIN. Just kidding, I don't know that they actually do that, but they're very willing to give their employer identification number out to say, we have someone who has attended your after-school care program and we'd like to report that for the 2441. Can we verify what the taxpayer identification number is? So it's a relatively quick process, especially if they have the form that'll indicate how much care they have. But this is a popular credit. Again, it's eligible for everyone coming into VITA, and even those who are not VITA eligible can actually take this if they meet the other requirements as well. Now, getting into a few fun areas, education credits. This is an area that we actually have a couple areas that we can help make decisions for clients. As we talked about, there's a tuition fee deduction that's still sort of in limbo for the time being. It's not yet extended. But generally what we're going to see is these education credits are going to be much more powerful. And there's two specific areas in the 4012, the J4 and the J5, that'll help give a little bit more information about these credits. The one that we take a look at, there are two that are available. The one that we try to get taxpayers in, if they're eligible, is the American Opportunity Credit. The American Opportunity Credit is essentially designed for individuals who are in their first 4 years of undergraduate education, and it's going to be limited to those first 4 years. And after that, individuals may be eligible for what's called a lifetime learning credit. Lifetime learning credit can apply to any type of education, whether it's a post-bachelor degree, and we'll talk about situations if you have a taxpayer who says that they'd like to go take a course at HAC or F&M. They've always wanted to learn Latin, so they're going to go pay tuition to learn Latin. That can count as a lifetime learning credit. The eligibility that we have is basically it's going to be the taxpayer, the spouse, or dependent who's going to be claimed on the return, as long as they're the ones attending the post-secondary education institution. So typically what we may see, if you have a client that comes in, they may be the student themselves, or their spouse might be, or they might be the parent of a student. And again, the student dependency exemption goes up to the age of under 24, as long as they're a full-time student. So in order to take the credit, you may not be a dependent on someone else's return. So if a parent is taking a dependency exemption for a child, the child may not take the education credit. So they cannot take the credit if they're being claimed as a dependent on someone's return. Not surprising, you may also not take this credit if you're married filing separately. So married filing separately will take the education credits out. Now, in most cases, what we're going to be looking at is tuition. Tuition is going to be the base amount that we're going to use for the credit itself here. We also can use certain related expenses and fees, and we're going to talk about a couple of those and how they differ a little bit between the two credits. The things that don't qualify are going to be what we consider personal living expenses. Room and board. Room and board is not a deductible or an accountable expense for the credit purposes. Room and board to the IRS is basically your living and your housing, which what we need to do anyway. So they're not going to give you credit for amounts that you pay. Even if you feel the dining plan at schools, you're paying a lot more than what the actual value of the food is. There is no additional benefit that we can get from that payment. Likewise, any other personal expenses, your clothing, your insurance, your transportation, your commuting. So when you send your student off to school and they have to go to the bookstore and they outfit themselves in every possible sweatshirt and t-shirt and everything else, that's great. You're going to show school spirit, but those are not eligible expenses for the education credit. Now, getting into a little bit more detail, in the J4, we're actually going to take a look at the difference between the American Opportunity and the Lifetime Learning. So the American Opportunity Credit is, again, the most powerful of the two credits. It's going to be eligible for the first 4 years of undergraduate education. The reason why it's so powerful is that you can actually get a $2,500 credit for your client, part of which can be refundable in up to $1,000, based on $4,000 of expenses. Now, just to let you know, if you haven't priced colleges lately, $4,000 is not a high hurdle to get over for tuition, especially if you're going to be considered a half-time student. It's a relatively low threshold to get into. So what we're going to see is if you're in the first 4 years of education, you may qualify for the American Opportunity Credit. The expenses that we're going to take a look at here are obviously going to be your tuition. That's going to be our base as well. But they also include any related fees, any course materials, any books, any supplies, any equipment that you need for study. So if you have an individual who's in a nursing program and they have to buy scrubs, that would count. If they're in a program that has a technology fee associated with it, those would count as well. Things that don't count would be sort of your ancillary fees. If you have to pay a fee to use the recreational facilities at the college, that's not an educational fee, that's a personal expense. You have to be enrolled into college on at least a half-time basis. And you can ask an individual if someone's enrolled at least a half-time, and they may or may not know, but there's a very easy way to find out. One of the things that's required to fill out this application or the credit form itself is called a Form 1098-T. So the Form 1098-T is going to be issued by the academic institution. The academic institution is going to have to report certain items that would include their name, their address, their taxpayer identification number. They also have to report the information for the student, who the student was, their social security number. They're also going to report a couple other things, including there's a box to say whether or not that was at least a half-time student. So it's important to take a look at the 1098-T. That'll help give us some information. It's going to also what helps generate the information we need to complete the 8863. So the student has to be at least half-time to qualify for the American Opportunity Credit. If you notice that there's an issue with the 1098T, best solution is to go back and see if the education institution can reissue the 1098T. So if they forgot to check the half-time box, you should probably see if they can go ahead and get one redone. You may have a taxpayer that says, I didn't get mailed a 1098T. You may want to double check. A lot of institutions now will have that available electronically for the individual to download rather than to just mail it to them. One of the other things that I highly suggest is if a taxpayer comes in, we do want to double check what is being received for scholarship. Now the 1098T will typically report the amounts that are going to be billed, not the amounts actually received by the institution. So it may be worthwhile to request a bursar transcript. And the bursar transcript will show all the payments going in and out of the institution for that year. So what we want to do is to take a look at the actual payments made. And what we're going to try and make sure is that we have at least $4,000 of qualified payments going to tuition-related expenses. If there is a non-taxable scholarship, we have to reduce any of the amounts billed by the amount of that non-taxable scholarship. A question has arisen, can loan proceeds qualify? Absolutely. If you take a loan out to help pay for tuition, you can still take an education credit based on those loans because you still need to pay that money back at some point in time. One of the other things we take a look at is this is going to be for the first 4 years of education. So typically, when we take a look at students matriculating in the school, they'll typically start in an August timeframe, and they'll actually graduate 5 calendar years from that point in time as a traditional semester will run from basically kind of August through May. Now, one of the differences we have here is the payments that an individual makes. Typically what the process will be is that you have to prepay your tuition for spring semester before the end of the year. So if you pay your tuition, and that tuition is going to be used by a student within the next 2.5 months of the following year, we can count those payments in the year that they were made. So for example, if you have a student who is just starting out in college, they would have started school in August, you would have gotten your first tuition bill a couple months before then. As you're ready to go off to their spring 2019 session, you're probably going to get a tuition bill sometime between now and the end of the year, which will be due probably before the student gets back to campus. If you made the payment in 2018, those payments will both count for purposes of the education credit. And it's going to be important because typically what will happen is a student will graduate 5 calendar years after they started. So we just have to watch that we don't try to take that education credit in the 5th year. Once they have 4 years, they're done. They can't take it in the 5th year. But it may not matter because typically your spring tuition is always billed a couple weeks or a couple months ahead of time. So we may actually have those lined up fairly well with payment. Now there's one other little wrinkle with the American Opportunity Credit. Probably one of the most difficult questions you'll need to ask to your clients as they go through the process. It's something that's required as we fill out the form. And you may want to preface it to say, in order to complete this, I need to ask the following question. Remember we talked a little bit about certain taxpayers have benefit over others. We see the educators getting a benefit except for the PE and the health teachers, which apparently Congress people don't like going to gym or taking health class. Someone had a problem with drug felons getting an education credit. So we have to ask a question. Were you convicted, not charged, were you convicted of a drug felony? Essentially possession, distribution, but it has to be a felony. Now the interesting part, you can have any other felony you want. You can be arrested for bank robbery, for hijacking, for threatening the president, for whatever you want to do. You can have any other felony conviction except for a drug conviction. So we got to a situation where apparently we didn't want to educate people who had a drug felony. And so we don't understand exactly how the laws are made, but I can only imagine that there was some sort of discussion around a table to say, I like the bill, but I can't vote for it unless I get my own little pieces in here. My constituents won't allow me to allow convicted drug felons to get educated and receive a benefit for it. So a drug conviction only, a federal felony drug conviction. So it has to be a felony. Can either be a federal or state felony, but it has to be a felony conviction. Misdemeanor doesn't count. So you don't have to open a whole can of worms to have people say, What did I get convicted of? We're not asking anything else. It just has to be, were you convicted of a drug felony? They generally know whether or not they were. Hopefully it's not a question that they have to go check with their attorney about what they had. But if they had a drug felony, they're ineligible for the credit. But all is not lost, because they actually have the lifetime learning credit, which is applicable. And the lifetime learning credit is another credit, not quite as powerful, mainly because it is now based on 20% of your eligible expenses, whereas we only needed $4,000 of tuition and related expenses to maximize a $2,500 credit, $1,000 of which could be refundable. Now we're getting to a point where we have a non-refundable credit. It's 20% of the eligible expenses. So to maximize the full $2,000, we need $10,000 worth of tuition. There's no limit for how many years this can be claimed. So if you have someone coming in and they're working on their third PhD, that's entirely eligible for the lifetime learning credit. If you have an individual comes in and they only are taking one credit at an institution, that counts as well. They don't have to be enrolled at least half time. They can be convicted of whatever they want and still take the credit. Now, the one difference we have, tuition will still count, but when we take a look at other course expenses, sort of your books, your supplies, your fees, equipment, they have to be purchased from the institution. They can't be purchased outside. And just a little note, textbooks are generally cheaper, not through a bookstore. So if you want to save money, you can actually buy textbooks either used or through an outside third party. But if you do that, they do not count for the tuition fee deduction, for the, the lifetime learning credit. They have to be purchased through the institution, through their bookstore. But this is an opportunity. So if someone comes in and says, I just had a course that I had taken, I wanted to learn about astronomy, I went off to Millersville and took an astronomy course, they can actually take a 20% credit. Non-refundable, meaning they can offset their tax liability dollar for dollar, but still a powerful credit. All right, one that we'll talk more that is a little bit more automatic. This one's going to be the Retirement Savers Contribution Credit. A little bit more information on the G9 of your 4012. This is going to be eligible for individuals who contribute to retirement plans. So this can either be an individual who contributes to a Roth or a traditional IRA. Again, you may need to make a inquiry to them if they've made a contribution to a traditional or Roth account. Those would be eligible. So what's unique about the Roth account is we don't get a tax deduction if you put money into a Roth account. You get all the money back tax-free if you meet the eligibility rules. But if you meet the AGI rules, if you meet the other requirements here, you can actually get the government to help subsidize your contributions to a Roth or a traditional retirement account. This is the one area in the tax code we see a double tax benefit, because not only do you get a tax deduction on your other accounts, your traditional IRAs, your 401ks, your 403bs, but the government may give you a credit on top of it. So you're not only not paying tax on it, but you're actually getting some additional money back. So what we're going to take a look at here are some other opportunities. Generally, we're going to see these triggered off of elective deferrals to retirement plans. And the nice part, why I say it's automatic, because if you enter certain codes from the W-2 into the tax system, it's automatically going to calculate the credit for you. Generally, what we're going to see are 401k, 403bs, simple, SEPs. They're going to be reflected with a couple codes. And it's going to sound like we're going through Sesame Street here. I'm going to name my favorite letters. But when we go through and we see a couple codes, a D, an E, an F, a G, an H, an S, 2 A's or double B's are traditionally the codes that will automatically calculate this form for you. So what's nice is that taxpayers may not even be aware that they're getting another benefit. So there are a lot of benefits for encouraging retirement contributions. One is they may get an employer match. Two, the government may actually go ahead and help subsidize that by a retirement savers credit. The one caveat we do have, there are a couple eligibility rules here. One is that the taxpayer cannot be a dependent or full-time student. So if they're a full-time student at an institution, they cannot take the retirement savers credit. Likewise, if they're a dependent on someone's return, they cannot take the retirement savers credit. Again, these are questions that we'll actually answer in the beginning of TaxSlayer, so you don't have to ask it again, they'll automatically know it. The next one will actually be automatically generated as well. They actually have to be born before January 2nd of 2001. So January 2nd. This is kind of an odd approach. Most of the times we talk about dates and it has to be by the end of the year, right? We've talked about kind of the age the taxpayer reaches by the end of the year. Their marital status is determined by the end of the year, effectively December 31st. This is a case where we give a little bit of a break to our January 1st babies. So I'm not quite sure if the IRS got a soft spot in their heart for someone who's sitting there in the hospital, 11:58 New Year's Eve. The doctor says we have two choices. You can be the last baby born in the current year, or we can hold off a little bit. We'll get the newspaper in here. You'll get your picture taken. You'll get a nice little welcome basket. Front page, first baby born in the new year. So if that happens, if you're a January 1st baby, you actually are considered a year older. So you're actually outside of that realm. Again, we don't need to really worry about it. It's going to be automatically generated. Just something kind of unique to see that the government has actually allowed a January 1st baby to be considered born in the prior year for purposes of the retirement savers credit. One thing we do need to just make a calculation on, or an inquiry on, is that the retirement savers credit has to be reduced by any amount of retirement distributions taken in the prior 2 years of returns. So if we're looking at 2018, we need to inquire from the taxpayer, did they have a retirement distribution in 2016 or 2017? Or will they be taking a retirement distribution up until the extended due date of the return for the 2018 year? So that means all the way through October 15th of 2019. So if they have a retirement distribution in 16, 17, or through October 15th of 2019, we have to reduce the amount of eligible contributions by that distribution. The intention behind here is the IRS doesn't want to go ahead and provide a credit in 1 year and then have the taxpayer take the money right back out again, or have the taxpayer take money out of a retirement account and the next year put it back in and essentially double dip by taking a retirement savers contribution credit. So just one question we have to ask if they've had any distributions from a retirement account. If they've been coming to VITA, we'll probably see that they had a 1099-R in prior years, or at least take a look at their returns as they bring those in. Okay, a couple things that we want to take a look at here are now moving from the non-refundable credits. These are the good ones, but this is going to be like a self-help. We're going to go from good to great. We have some very awesome credits coming up here, some very powerful credits. These are our refundable credits. These are going to be the things that are going to really make the clients happy. We talked about issues in the past about what to do to make sure clients owe money. How do we handle those situations? How do we be sure the client's giving us all the information we need to help prepare the return? This is going to be the things that you do to get hugged by your client. So just be aware if you see some of these and you don't like getting hugged, just kind of mention that right away before you tell them the refund amount. Because these are going to be the things that really drive people into VITA. These are going to be the ones that are going to help them get money back into their pockets. These are our refundable tax credits. These mean that they can get a refund even if they owe no tax. So if they have no tax liability, they can still get money back from the government, up and above their actual withholding. So one of the first things we're going to talk about is the new child tax and credit for other dependents. This is change from prior years. So if this is your first time preparing a return, we'll teach you everything you need to know. If you've been preparing returns for quite some time, we'll teach you everything that's changed about the credit. This is going to be on the Form 1040. It's going to be on the line 12A. So it's actually not going to be on the Schedule 1. It's just going to be on the line 12A. It's going to also have a component where we may see a refundable amount or additional child tax credit on the 8812. We'll talk about the earned income credit, which is going to be a nice way to, again, enhance our client refund opportunities. If we do have any estimated payments, that is now going to be shown on the Schedule 5. So if there are any estimated payments that clients made, or if they have a carryover from a prior year, that would all be reflected on the new Schedule 5 for the Form 1040. Okay, now heading into our tax credits. Child tax credit. In prior years, this has been a $1,000 credit. This is now bumped up to $2,000. We also have the opportunity that up to $1,400 of this credit can convert to refundable status. Automatically, we don't need to do any calculation with it. The system will go ahead and calculate that. The other issue that we've taken a look at here is that, not that it'll really apply too much here within VITA, but the AGI limitations have increased. Most times, if individuals were not coming through VITA, they may be limited or not eligible for the child tax credit. The AGI limitation is now $200,000 for singles, $400,000 for married filing jointly. So it's going to have a lot more people eligible for the credit. One of the reasons we're going to see these credits change is that we talked about dependency exemption at the very beginning of our sessions. We don't have a personal exemption anymore. That amount is gone from return. So it's a $4,050 benefit for every person you took as a dependent on your return in prior years. That's no longer available. What they're trying to replace it with is this child independent care credit. It may not be exactly dollar for dollar. You may have some situations where clients may not have the same benefit they've had in the past, but a lot of our clients may be actually getting more money back, because what we do is we've changed our dependency exemption now to a credit. So if we're taking a look at the child tax credit, again, this is going up to $2,000 per eligible child. It's going to be partially refundable up to $1,400. Again, the system's going to do that automatically for you. Couple eligibility rules. The child has to be under the age of 17. So again, we're talking about how do we define child. The IRS changes the definition again. It's effectively the same thing that we looked at for the qualifying child dependency, but we're going to make some modifications. So the child has to be under the age of 17, meaning the last year they can take it is the year in which they've turned 16. Once they turn 17, doesn't matter at what point in the year, they're no longer eligible for the child tax credit. Again, if we take a look at the IRS logic, at the age of 13, you can care for yourself. The age of 17, you don't cost much at all to your parents, right? It's a relatively easy period of time. They don't want to drive. They don't eat much. They don't want to wear new clothing. They don't like electronics. They don't really need a subsidy to help in the household. So we have a little bit of a gap year typically between the time that they're turning 17 and the time they go off to college. But they're not eligible for the child tax credit. We'll talk about another credit they may be eligible for in just a second. But they have to be under the age of 17. They also have to be either a U.S. citizen, a U.S. national, or a U.S. resident. So we don't have the opportunity anymore. When we talked about dependency, we allowed individuals to take a resident of Canada or Mexico. They actually have to be a U.S. resident or a U.S. citizen or U.S. national. They have to have a social security number as well. So ITINs do not work. They have to have a social security number by the due date of the return. So whenever you file the return, they have to have a social security number. They also have to be claimed as a dependent on the return. So we mentioned about traditionally, we'll go through the rules. A non-custodial parent can take a child as a dependent if they have the form 8332 filled out. They can take the child dependency exemption, and the dependency exemption will also qualify them for the child tax credit. So the child tax credit is going to follow whoever has dependency. All the other benefits we're going to talk about children follow custodial relationship. But the dependency exemption is going to trigger if you're eligible to take that individual as a child tax credit. Now the additional child tax credit, again, this is going to be automatically calculated. This is going to be similar to the rules that we've seen in the past with a few modifications. So first, if you have earned income over $2,500, it will automatically go through the calculation, kind of a little bit of a sausage making process here. We can show you how the calculations work. But basically, it's going to be 15% of any of the income over $2,500 or the amount that hasn't been used by the taxpayer. So if they have already used all their credits, they've exhausted all their tax liability, part of that can now become refundable automatically if they have earned income, or if they have 3 or more children. So if they have 3 or more qualifying children, that will automatically, irrespective of earned income, become in the calculation of partially refundable. So that's kind of a nice little benefit, a little bit of a change than prior year of what we had. The credits doubled. The amount of refundable can go up to $1,400. The rules are essentially similar to what we've seen in the past. What's going to be new this year is actually this new credit for other dependents off G15. So we talked a little bit about dependency in the first session. We talked about, well, we don't have personal exemptions anymore, but we do have something that we want to talk about today, and that's going to be our credit for dependents. This is a $500 credit. Again, kind of replicating what they would have had as a personal exemption. We don't have that anymore, so the credit is supposed to replace that aspect. So if someone does not qualify for the child tax credit, they can qualify for the $500 dependent credit. So this could be someone who may be a qualifying child for dependency purposes, but they're over the age of 16. So a college-based student or someone who's turned 17 can still qualify for a $500 credit. Also, we can take a look at the dependency tests for qualifying relative. So if they don't meet the qualifying child test, now we go back to that qualifying relative that we had seen on C4. So if you're a qualifying relative, part of which, you think back, that was the first definition was someone not even related to you, as long as they lived in your home for the entire year, they can qualify you for a $500 credit. Again, what we're going to take a look at is we've narrowed that down a little bit. They still need to be a resident of the US, a US citizen, or a US national. So residents of Mexico and Canada do not qualify. Now, in this case, they need to have a social security number, an ITIN, which is basically an identification tax, individual tax identification number, or an ATIN, which is an adoption tax identification number for an adoption process. So they can have an ITIN, an ATIN, or a social security number and still qualify for the dependent credit. That's going to be $500. Again, same things apply. AGI limitation, $200,000 for singles, $400,000 for married filing jointly. So we're going to see a lot more people qualify for these than what they have in the past. All right, so a couple changes. We're going to finish off where the loud music and the pyrotechnics come in. This is the most powerful credit we have in VITA. For those of you who are brand new and you may not have heard about the earned income credit, this is what generates our highest amount of refunds for clients. This is the opportunity to bring money back into the hands of those who are working individuals who are not high wage earners. The earned income credit is the most powerful credit we're going to be dealing with. It's going to be refundable, and it's going to be refundable in a fairly high amount. The I-2 is going to be the information in your 4012 that covers a lot more of the information that we'll be talking about for reference as you're going through the exam. But again, the earned income credit is a refundable credit. It's going to be designed for workers that don't have high income, but they have to have earned income. So when we talk about earned income, we're going to talk about a couple things. One is wage income. So the majority of people we see within VITA that qualify for the earned income credit are going to have W-2s. It's going to come off their wage